Hello, I'm Mark Dunn and I'm the editor of investment magazine Portfolio Institutional, and welcome to this discussion which looks at the rise of transition investing. It's a big theme. Unless we move the economies away from being driven by extractive forms of energy towards more renewable, cleaner assets, then we're not going to have much of a future. The issue is, of course, it's going to take an awful lot of investment to create reliable alternatives to fossil fuels. But the good news is a lot of the asset owners I speak to are very much on board with this, and they're very much factoring this into their investment decisions. So it's very apt that we're going to talk about this today. And of course, I'm joined by two guys who know all about this. David, would you like to start us off with introductions?
Of course. Thank you, Mark. My name is David Oker, and I head up the ESG investment team in fundamental fixed income here in EMEA. My team look after a green bond analysis for the firm. We have created several investment frameworks, including a climate transition focused one, and we co-manage a number of sustainable portfolios.
Gotcha. Thank you very much. Good to have you with us. Thank you.
Thank you.
And Shurab.
Thanks, Mark. So my name is Saurabh Katyar. I'm heading the EMEA Index Solutions Research team based out of London. My team's role is to engage with institutional investors, asset owners, asset managers, product providers on a range of index offerings, but we particularly focus more on ESG and climate indexes. And then I also work closely with clients who develop custom index solutions.
Thank you, Shurab. Thanks both being here. Okay. David, could you start us off? Where are we on the transition to a low carbon economy?
The transition to a low carbon economy is a mega force reshaping the global economy. It's driven by changes to societal preferences, to technology that's available, and also by policy. And all of these interact and shape the speed of the transition. And that in turn shapes how we have to think about this from an economics perspective, but also how we think about it in portfolios. One thing, if you look into history, transitions are always happening. So you can think, turn the clock back a little bit to the early 1900s here in the UK, when you had a transition from a gas being used to light houses to electricity.
Yes.
Or if you think about adoption rates of radio, of TV, of smartphones, for example. Yes. And the one thing they all have in common is that the market underappreciates the speed at which that transition is happening, and how, once it gets started, monumental that can be. So one thing we have done is to try to understand the low carbon transition. We employ a lot of scenario analysis to really try to understand some of these driving forces and how they interact with one another. And so, for example, we expect there to be tipping points in terms of technology, whereby the cost of some of the low carbon technologies, as you mentioned, are actually falling below those of the incumbent sources. And we see generally a difference in speed in the transition between different markets. So developing economies being a little bit slower to transition than the developed economies, such as the UK. Whereas emerging markets, developing economies, of course, are such a pivotal place to transition. And there's a lot of potential there, but of course markets there face very steep borrowing rates. Yeah. So to answer your question, I would say we are in a place where we're still understanding the different impacts and drivers, and as we'll talk today, we will see a lot of. We'll hopefully be able to explain that and these drivers a bit further.
Sure. Thank you, David. Thank you. And Shurab, do you have anything to add to what we've just heard?
Yeah, so I think David has already made some very good points about where we are on this journey towards transition investing. So maybe I'll complement some of those points by mentioning about the evolution that we are seeing when it comes to investment approaches for low carbon transition investing. When we speak to our clients, mainly institutional investors, what we see is that their focus has evolved in the last couple of years. So, and I think this is fair because their understanding of climate change as a systemic force is evolving. They understand that a multifaceted strategy would be required for this, low carbon transition investing. And when we speak to our clients, what we see is that decarbonization is still an integral element of low carbon transition investing, but at the same time, they want to take a broader approach. They want to look at a security level assessment where carbon intensity, of course, is an important driver, but also what the companies are committing to do. Are they committing to reduce their emission intensities? Are these emission reduction targets credible, for example? Are these companies incorporating technological solutions to green their operations, products or services? And these are important factors as well. Now, when we also another thing that is driving this low carbon transition investing is the greater allocation to low carbon solutions, and that is an approach which institutional investors are adopting, both to seize some of the opportunities being offered and at the same time being guided by some of the policy and the regulatory framework. So, for example, the EU's RE-Power EU or the US Inflation Reduction Act, some of these policies are promoting the adoption of low carbon solutions, and as David mentioned, their costs are falling, which as a result helps the adoption of these low carbon solutions as well.
Okay. Because the transition to a low carbon economy is rewiring economies, sectors, businesses. But how are investors thinking about this?
Yeah, I think, first of all, I completely agree that when we talk about this low carbon transition, it is going to touch upon all sectors of the economy, especially some of the more carbon intensive sectors like energy, materials, utilities. And I think when we talk about these, rewiring, this also going to create risk, but as well as opportunities for investors. So there are more carbon intensive assets. Some of these assets may be left standard. They may not fully realize their economic potential. There would be companies who have more carbon intensive products, services. These products may face lower demand. The services may face higher operational costs, etc. So these changes would need to happen. But at the same time, those companies who are leading some of these transition efforts as compared to their sector peers may also be something which investors would be keeping a close eye on. Another thing which we see is that this let's say promotion of low carbon solutions that is also impacting the earnings trajectory of these companies. So we did an MSCI research, and we looked at the earnings profile of some of the companies in the high carbon intensive sectors like energy, materials and utilities. And what we found was that companies who have green revenues, they have superior earnings growth as compared to their own sector peers which have lower green revenues, for example.
Okay. Interesting. Right, self, David, I mean, how are you seeing investors thinking about this?
I think firstly it's very important to underscore the point around scale that was made, because the scale of the problem is truly one that's unprecedented. So if you think about just the investments in the energy system that are needed alone, we're talking about 4 trillion in the coming decades that are needed annually. Bloomberg New Energy Finance have estimated the funding gap between where we are today and the ambition to get to net zero to be at $7 trillion per year, every year until we hit 2050. So it's truly an enormous scale. And because of some of the interplay between policy, technology, and consumer preferences, this in essence shapes, as you mentioned, all the different sectors that we invest in. And so for us as investors, thinking through how each and every company that we analyze is meeting these risks and opportunities is crucial to how we build portfolios. So understanding where are those companies benefiting from contributing to the transition, and those perhaps that are lagging behind their peers. And so what we look for example, is we look into transition plans, or whether companies have set science-based targets, where they spend their green capex. Just as an example, to give you some ideas of how we look at the issuer. One thing in fixed income market, which is and I'm biased here, which is why they're the most interesting market, is that we have certain instruments that are unique, such as green bonds. And I'm sure we'll talk about this later, but these instruments are unique to fixed income. They allow us to, they allow issuers essentially to raise capital for specific projects, use of proceeds, and then they tell investors what these projects are, what they're to be used for, and then we can come to a view on the greenness, the impact of these projects, the structure of these bonds, and it gives us very unique insight into how these companies are actually transitioning, and then allows us to use these in a number of portfolio applications.
Very good there, but could you tell me a bit more about the approaches to incorporating transition investing into portfolios? For
sure. I think there are many different ways one can think about transition investing in portfolios. And each investor and each investment process is ultimately different. When we get asked this question, we really think about it along these dimensions. I think firstly, First and foremost, it's really important you measure and understand what your starting point is. Right, and that will be shaped by your existing asset allocation, your regional split, whether you have privates and public, how much sovereign versus credit. So a lot of work, I think, has to be done understanding where you're starting from, and then being really clear about what it is that you're trying to achieve. For some clients, the answer to your question may be that they're really seeking to reduce emissions intensity. So have a focus on that, picking companies with low emissions intensity, which then has an implication for example, the sector composition of such portfolios. And others may come to the conclusion that transition investing should really mean investing in a portfolio of companies that looks very closely like the current sector makeup, meaning you include some of the high emitters, cement companies, utilities, perhaps even energy companies, and then within that, you pick those companies that are transitioning the best. And so being really clear about what your objectives are, how you measure success is important. And then in the third and final step, you get to essentially pick the bonds, right? So, or equity securities, I suppose, meaning we have to then look and analyze to the answer to the previous question, what's the likelihood of alignment? Are these companies aligned to net zero? Are they committed to aligning to net zero? And for that, we use our own research, but we also leverage some of the fantastic industry frameworks. For example, the IRGCC Net Zero Investment Framework that's come out with some really powerful guidance to then help construct portfolios to what our clients want. Because ultimately, we as an investment manager are fiduciary. And so we work with clients, we offer them a lot of choice to create portfolios that meet what it is that they're looking for. And it's best done when we're all clear about the objectives we're trying to achieve and we're all pulling in the same direction.
It's quite an insight. Thank you very much for that, David. Schwab, have you got anything to add in terms of the approaches to implementation?
Sure, yeah. So I'll first latch on to something what David mentioned and which we believe is very central to climate investing is fiduciary responsibility. So whenever we talk about climate investing, whether that's part of satellite allocations, core allocations, we first need to recognize that investors would have fiduciary responsibilities. Yes, they would have different approaches, but that's central to their consideration. Now, when we speak to our investors, when it comes to low carbon investing, we generally see three kinds of approaches. First, maybe just decarbonizing. So in this case, they are still maybe coming up to speed on what climate change entails, and they're just looking at a maybe simpler solution, trying to just achieve a solution which has lower carbon intensity within a very strict tracking requirement, for example. The other solution which sometimes our clients have adopted is, and something which has become more prominent after the EU delegated acts were published, was alignment with a decarbonization trajectory. The reasons are very intuitive. This helps them through a portfolio rebalancing mechanism, continuously reduce their emission footprint on a year-on-year basis. It's become quite popular, but it has its own advantages, drawbacks, etc. But the one approach which we have seen gaining more traction, and something which we touched upon previously, is a more comprehensive assessment of a security or of a portfolio based on the transition profile. And in these cases, the investors, they're also trying to contribute to the real economy decarbonization, contribute to the transition economy. They are trying to have a more sector balanced approach. So not deliberately underweight some of the high carbon intensive sectors, energy, materials, utilities, for example. And even at a security level, depending on the transition readiness of the companies or the transition profile of the companies, they will use that as a factor, whether to look at from a portfolio selection or from a portfolio weighting perspective. Now, these are all standard solutions which we offer as a firm to our clients. But when it comes to asset owners, pension funds, we see a lot of customization happening as well, where they will try to maybe bring in their own exclusions. They will maybe try to bring in an ESG objective or try to bring in a factor integration as well. So there is a lot of complexity out there as well, but at the same time, a lot of commonality when we look at these investment approaches.
Thank you. Thank you. Final question now, Rob. If we can start with yourself, what are the headwinds and tailwinds of the transition?
Thanks, Mark. I think it's a good question to finish with.
Yeah.
So I think, first of all, I think we need to recognize that when we talk about climate change, the roadmap to climate change and the low carbon transition, it's going to be a complex, journey, multidimensional in nature. It's going to be influenced by social, political, economic, as well as technological factors. It's got a lot of headwinds. Some of them maybe I can touch upon. I think the first one, which in my view is important, is the policy and the regulatory support. So I maybe touched upon this in a previous answer, but the US Inflation Reduction Act, the EU's RE Power EU, but even some of the broad international agreements like the Paris Agreement, they are helping drive the adoption of some of the more carbon efficient solutions. And this clearly influences the financial and the economic drivers. So as these policies, frameworks come into place, they help reduce the cost for some of the low carbon solutions, they help drive the higher adoption of these low carbon solutions, and as a result what we see is that it impacts the the investments flows into some of these sectors. David already mentioned about a BlackRock report. There was a report which International Energy Agency has published, and they have talked about significant investment flows into the energy sector, more than doubling to $5 trillion USD by 2030.
Okay.
Similar size of investments would also be needed in some of the other sectors, and this is also going to create opportunities for investors.
Yeah.
So these are maybe some of the headwinds, but if we talk about maybe some of the tailwinds, there is again the path to low carbon transition is uncertain, and this is maybe going to create some financial economic challenges as the investments are driven towards some of these technological solutions. Some of the technological innovations which need to happen would need to keep pace with some of the demands. So for example, the current clean energy storage solutions, they're not fully sufficient to meet the intermittency needs of the renewable energy like solar or wind power, for example. Finally, I also mentioned that the policy and the regulatory support is a headwind, but the lack of persistence or the lack of long-term policy and the regulatory support and even the consistency of this across countries could become a headwind as well. So if I have to summarize, I would say that there are a lot of challenges, but there's a very strong momentum driven by the policy regulatory support, driven by the technological innovation towards the transition to low carbon economy.
That's true. Thank you very much, Rob. Thank you. And David, last word to you. Headwinds, tailwinds, where are they?
Thank you. I would perhaps just add 2 points to the very comprehensive answer. I think firstly, we have to appreciate that we're talking about really a profound set of shifts playing out globally over a period of decades that reshape production and consumption globally, right? So there will be tailwinds and headwinds along each of these dimensions as you perhaps surpass technological tipping points at different times in different regions and different sectors. And so one thing we certainly think about a lot is some of the execution risk that's inherent in that.
Yeah.
That's certainly one of the risks we would add to the answer. Secondly, you have to also think not just about the technological tipping points, but also some of the climate tipping points, and also appreciate some of the physical risk we've already seen. You think about, for example, the heat waves we have seen across the globe, or some of the weather phenomena that we have seen. And so the potential impact on economic growth through these physical damages related to extreme weather or climate events is going to impact particularly some of the political points I think you've mentioned very well. And so the interplay of that I think bears very close watching. And I'll end on this. One thing that gives us hope, I think, is that there are a lot of innovative solutions, whether that's green bonds being deployed through the capital market, new technologies emerging, an appreciation of this being really a global problem that's addressed in many different ways. And so, not to end on a positive note, I think there's a lot we can look out for, but it's a really complex shift that's happening, and so that in itself bears risks.
Yes. So the energy transition, achieving net zero, is one of the biggest challenges of our time. So David, Sharab, thank you very much for joining me and for sharing your views. Thank you.
Thank you.